So this is the 10-year Treasury note. It always has a nice fancy building on if you look at like a Treasury. So I just drew a nice building as a $1,000 price 10-year T note. So the current yield tells us about the current economic landscape, what the expectations are for the future, and global market sentiment, how people feel about the future, which is very related with the current economic landscape. And here's how it works. The 10-year always has a face value of $1,000. That's how much you get paid from the government after your holding period ends. We're going to explain this even further. And they always have an interest rate to be paid to you as an investor loaning the government money. And this is also called the coupon. Now, notes are sold to banks and financial institutions from the Fed. So the Fed sells banks and institutions these notes, and then the 10-year is sold on a secondary market to you and I and any other investor. And this secondary market is what actually determines the rates that we were looking at that are shrinking. Now, this is where it can get confusing because the Treasury price, the Treasury price increasing actually means the Treasury yield is decreasing. So when you hear Treasuries are going up or they're getting more expensive, that means the yield is going down. Or that works vice versa, where if you hear the yield is going down, that means the price is going up. So let's explain why this happens. This is because a 10 years face value is not equal to what you pay. It's equal to what you receive in return. So that $1,000 face value is what you receive from the government after the time has passed. So you loan the government a set amount of money, and then they give you $1,000 back for each of these notes. So you pay less than that $1,000 amount, unless for whatever reason yields are negative. But we're not going to get into that on this one. But how much less? This is what that secondary market determines. That's what the yield is, the rate of return on these notes. And here's the math on how it works. So if you buy a 10-year for $900, I don't know why I wrote just BY, I'm really doing shorthand here. So if you buy a 10-year for $900, the yield is 11.1%. And that's because you can do some simple math, taking 1,000 divided by your purchase price of 900, that equals 1.11. 0.11 is your 11, it's one repeating, so 11.1% return. Now, let's say demand for the 10-year goes up. More people want to buy the 10-year because they want an ultra-safe investment. Now, when the demand goes up, that means the price of these notes also goes up. So let's say the price went from $900 and now the price is $975 for that same 10-year $1,000 Treasury note. The yield here now decreased to 2.5% because of that same math. $1,000 divided by 975 equals 1.025, which is your 2.5, it's actually 2.6% yield. Now, what increases the demand? And this is where the economic uncertainty comes in. Because, again, investors buy more of these ultra-safe Treasury yields. This is considered the most safe investment ever because the U.S. government has never defaulted on any of these or has never failed to pay these obligations. So when you're looking for the most safe investment, you buy these bonds. And you buy these bonds because you feel that the market uncertainty or where the market is headed is too risky, so you're allocating more of your money into this. Thanks for tuning in, and if you enjoyed this content, make sure you subscribe to the main channel as well right here.